So what's the big problem with wealth creation? How do people like us, who didn't inherit a boatload of money, who are investing and building wealth from our own blood, sweat and tears, how do we invest in a way that gives us remarkable results and become financially free before retirement age? I don't know about you, but I am sick of hearing from wealth gurus and experts who don't walk their own talk and prescribe strategies that are a one-size-fits-all approach. For self-made people like you and me, I'm here to tell you that you don't need to be superhuman or already wealthy to reach financial freedom earlier than 65. This is the Alternative Investing Podcast. Hey guys, welcome back to the podcast. It's awesome to have you tuning in. Today, I actually want to pick a very narrow and deep focus, which is to talk in a lot more depth about inflation. I know I've touched on it in past podcasts, but in today's episode, I actually want to go really deep on the idea of inflation. It seems to be on the lips of newsreaders, media reporters, governments, and definitely investors right now. And I actually want to pull apart some of my own views on how to think about it, what it means for you as an investor, and how you can be protecting against this high inflationary environment and continue to thrive. Where I want to start today is, clearly there are a lot of factors that drive inflation. Typically, just for those of you who are maybe just trying to wrap your head around it, really inflation results in a nutshell from either increasing the costs around production or an increase in the demand for products and services. So the last couple of years has created a little bit of a cocktail where both of those things have happened together. We've had a lot of money flooding into the economy. People have had more disposable cash to play with, to invest. And on the flip side, most businesses and manufacturers have definitely experienced a lot of stress, both from a supply chain and cost of materials perspective. So the bottom line is that if inflation is happening, then not only does that kind of affect the bigger cost of goods and machinery and things like that, but, basic necessities such as food, petrol, and so on, which is what we're experiencing now is, runaway prices can have a massive negative impact on society. I know some of you will kind of understand, but, in recent weeks, I've seen a simple iceberg lettuce selling for, like $13. Now, obviously, there's various reasons that we might have supply chain issues on one particular item, but inflation, when it starts to kind of permeate all of the goods and services that we need to kind of create our basic living, that has a massive implication. So the big problem with inflation, of course, is that as the cost of living rises, wages and incomes generally don't necessarily keep pace. And regardless of your level of affluence, the experience that people both at the high income earner level through to low income earners is that money feels like it becomes tighter. And at the moment, the big debate that's going on around the world is around what kinds of salaries can businesses pay in order to kind of, reduce the pressure of that inflation. And, the tension from a business owner's perspective is, a lot of businesses are feeling like they're just getting up and running after having had 2 years of being kicked in the guts. And it's really hard to now it's not that there's no, I think compassion for what, your everyday person is experiencing, but there's that tension between trying to keep the business afloat and keep it profitable and needing to pay people more money. So, with higher inflation, technically people are making less money. So I think what I really want to do to start with is I want to talk about what is the true inflation rate. So do we really know is the question I'm posing. I know that a good friend of mine and I were talking last week. He's someone who follows economic data very, very closely. And he was telling me a story that although, for example, in the States, the reported rate of interest or inflation is somewhere around the 7-8%, according to his metrics that he's following, it's actually closer to 15%. And to be frank with you, 15% feels pretty real to me right now. I think one of the things that I've witnessed over the last couple of years especially is economists kind of, pulling holes in some of the economic commentary coming out from the government, which unfortunately is designed to prevent people from panicking. And so there's a certain level of inflation that they know that people want to hear about. There's a certain level of growth that they want to hear about. And so when it comes to measuring things like inflation, they want to see it at a certain level, like that 2.5%, maybe as high as 3% mark. And so what happens is, and I've certainly seen this before, the basket of goods that they use to measure inflation sometimes gets tweaked or changes in order to manufacture the right numbers. And so there are a number of people out there, and this is what my friend was talking about, who are kind of going back in history and trying to measure inflation based on a single basket of goods, and therefore recognizing that in fact inflation is possibly at a level higher than what we're hearing about in the media. So really the question is, what are the implications of this? And I think mostly there are people who will lose as a result of this high inflation, but there are in fact some winners. And so consumers, for example, if we think about them as a category, experience very little benefit from inflation. However, investors can enjoy a boost if they hold assets in markets that are affected by inflation. So an example of that right now is those people who are invested in energy companies might see rises in the value of their stocks if those energy prices are going through the roof. From a business perspective, some businesses will reap the rewards of inflation because they can charge more for their products, and as a result of the surge in demand of goods, they can actually do very well. If the economy is performing relatively well and housing demand is high, then like builders can actually charge higher prices for selling homes, and we've certainly witnessed some of that in our local market over the last couple of years. So in other words, like really what I'm saying is inflation can provide businesses with pricing power to increase their profit margins. And if their profit margins are rising, it means that what they're charging for their products are increasing at a faster rate than the increases in production costs. So that's certainly, I would say, true for some businesses in the economy right now. But I would also say that there's probably more business owners that are finding this rise in inflation and therefore then on pricing their products to the average consumer a tricky game, particularly if there's vulnerability in terms of supply chain. So I think most companies are going to be hurt by inflation as a result of, surging production costs. And if they're unable to pass those higher costs on to consumers, say, for example, if there's foreign competition or, the consumer just can't tolerate it, then they're also going to be floundering. So governments clearly have a couple of tools in their toolkit to help keep inflation low. And we've already seen evidence of the governments starting to tinker with these levers. They can implement wage and price controls. However, I think the governments are pretty reluctant to do that because that obviously can lead to job losses and then push us into a recession. They can use monetary policy. They can reduce the money supply. They can alter interest rates. So these are all the things that kind of create a very complex cocktail when we're talking about what will happen over the next 12 to 24 months. So really, more than ever, and I keep emphasizing this, just be really careful about what you consume and be really mindful that nobody, and I mean nobody, can predict the future. So when you are hearing, reading, listening to opinions about what will happen in the future, what you really want to be doing is pulling back from that and applying as much as possible an educated element of probability to what people are saying. The thing that most people are interested in, so I'm going to skip ahead now, is how should you be thinking about and how should you be tackling this issue of inflation as an investor. So I've got kind of 5 key points that I want to make just to kind of give you a good, cross-section of thinking and action. So the first one is, and I know this is probably going to make you cringe, but the first thing I'm going to say is don't freak out. One of the things that we forget about, particularly when we're in a crisis of any variety, is that these crises, these in high inflationary environments, pandemics, recessions, all of that, they're all just natural part of market cycles. And more than ever, you need to distinguish between between being an investor and a trader. So we want to remind ourselves that we are playing the long games. So we want to focus on assets that are likely to perform and rise with inflation. So when I say that, I know this is actually really tough, but I'm sort of preaching, but I feel like I'm in the trenches with you guys, because it's very easy when something really big happens to panic. I know certainly if I think back to the beginning of 2020, when the pandemic first hit and, it seemed like the sky was falling, I made a couple of decisions around the allocation of, say, for example, my super that pulled me out of some of the shares that the super fund was in the market and moved more to a liquid position, meaning I realized a loss. And then, when that was, tweaked and we went back in again, it was like, oh God, like we should have just sat in and basically ridden that curve. And I think it's really easy to, and this is where I kind of want to say, I'm telling you what to do because my mentors have really guided me on decisions and thinking and have really helped me shape my decision making in the past. But we want to focus on, the long game and recognize that there are lots of fluctuations in the market during the process of playing that game. It doesn't mean we don't need to adapt our strategy to changing market conditions. It doesn't mean that we pick one kind of way to get to our financial goals and stick with it doggedly. What we want to do is recognize that market ups and downs are natural and that we are investors. We are not traders. We are not trying to predict the direction of the market. We are not trying to gamble and make speculative investment decisions. We are playing the long game. So I guess that would be my first key point is, just remind yourself that you are an investor. And if you're listening to this and you think otherwise, then you are definitely in the wrong podcast because we do not focus on quick wins and silver bullets in this podcast. The second thing I would say is that we want to distinguish between defense and offense when it comes to investing. So when I say that, what I mean specifically is that there's always real tension between holding cash and needing to invest it. When things are very volatile, there is a natural tendency, and rightly so, to want to keep better cash reserves. And this is actually probably very prudent. And certainly as your net worth increases, as the complexity of your portfolio rises, it becomes more and more important to be mindful of what level of cash reserves makes sense. And in an environment like this, where clearly there are massively dark, stormy clouds brewing, if there is likely to be a, pretty awful storm, tsunami, whatever thunderstorm, you want to be carrying enough cash to carry you through. An example of this, I spoke to one of my trusted advisors a couple of days ago, and he runs a very, very profitable, lucrative business, which specializes in one particular alternative strategy, which nets somewhere around that sort of 15 to 20% per annum net returns. So I look at his model and think, you must be living high on the hog, laughing all the way to the bank. But one of the things I love about, a lot of these guys, but this guy kind of articulated it, is that humility to recognize that nothing's infallible, nothing's bulletproof. And one of the conversations that we had was how he was making the decision to carry cash reserves that would cover all operating costs and salaries for 2 years, meaning if everything hit the skids, they would have more than enough cash in the bank. This is in the business, by the way, not his personal, but in his business, he would have enough to carry salaries and costs for 2 years. Now, is that incredibly conservative? I would say absolutely it is, but I can understand when you are an astute investor, your sensitivity to potential threats is heightened. And a lot of my trusted advisors are warning of, storms ahead. So I guess the point that I'm making on this second piece about defense versus offense is, I think we're kind of schooled and taught a lot in the greater community. And certainly a lot of self-professed experts argue for continuing to minimize cash reserves, keep a little bit of cash reserves to carry you for say 3 to 4 months, but invest everything else, because otherwise the opportunity cost of cash sitting around is too great. What I encourage you to think about right now is, in this high inflationary environment, while recognizing that your purchasing power of cash is falling at a faster rate, you've got to pair that with the knowledge that there are some pretty turbulent, environmental factors that need to be considered when you're thinking about cash reserves. And I know that from a personal point of view, I'm trying as much as possible to maybe even slow down the investing a little to make sure that I have adequate cash reserves in case something goes sideways. And, when you're answering the question, well, how much? I think the rule of thumb, things like keeping 3 to 4 months worth of living expenses in your back pocket probably makes sense in a kind of a flat or bullish environment, because obviously you can always have unexpected expenses. But we are hitting a, not just mild turbulence, but fairly serious turbulence right now. And, you've got to ask yourself the question, what are the vulnerabilities in your income stream? How likely is it that there could be any kind of fracture or disconnect or break in your income? And if so, given the cost of your life and the investments that you hold, how are you going to manage that if things don't go according to plan? And so really this comes back to sleep at night factor. I know one of my members was asking one of our advisors about this, and, in terms of what's right and what's wrong. And I think it's a tough question to answer. People are looking for formulaic answers like, oh, well, you should have 8 months of living expenses, not 4, that kind of thing. But I would actually say to you that a little bit of common sense, a little bit of making sure you've got some kind of cushion right now is really important. So I'd be letting go a little more of your offense and focusing on your defense, particularly if you have a large volume of investments. If you are someone who's an investor earlier in their journey, the burdens are not that high and you are still out there hunting for opportunities, you could do just as well with less cash. So I think it's really about, where are you on your journey? What is your mindset? What is your sleep at night factor? The only thing I'd just add to that is inflation has the same effect on liquid assets like cash as any other assets, except that, liquid assets tend to appreciate in value less over time. So they are more vulnerable to the negative impacts of inflation. So generally, higher rates of inflation tend to cause individuals and businesses to hold fewer liquid assets because they're worried about the erosion of inflation. But I would, again, emphasize the need to pair that with knowledge of maybe what's coming down the barrel. The next thing I would say is, one of the things I'm hearing from a lot of investors right now is they are trying to predict the future from the viewpoint of timing their investments. So, maybe how that shows up is thinking that they'll postpone their decision making around pulling the trigger on an investment until they can get a better price, believing that the stress in the market will increase, that it will become more of a buyer's market and give you the leverage to negotiate a better price on particular assets. So yeah, I think one person that comes to mind is I had a good friend a few years ago who was a financial planner, a very conservative guy, and who had decided to postpone the decision to purchase his principal place of residence because his view was that we were hitting the skids economically and the market was going to pull back further. In fact, what ended up happening is that we ended up having a mini boom inside of a bit of a bursting bubble. We happen to live in a market where there's a lot of government employees, so there's actually a little bit more protection. And in the time that he decided to hold off on making that decision, the market just surged as a result of, again, another left of field issue that no one could have predicted. And so, if you're someone who is needing to enter the market because you've got cash available and you want to get going on your investment journey, or you've got capital and you've got the capacity to keep growing your portfolio, I would say postponing decisions for the purpose of getting a better price, particularly during times of high inflation is really a bit of a fool's errand in a way, because I just think what you want to be doing is focusing on buying good assets at a reasonable price today that are likely to perform for you over the long term. So again, this comes back to this whole thing of, are you a trader or are you an investor? So trying to predict the future is, it's a difficult game. And if you're trying to invest, for example, in traditional property, you want to be investing in product and homes where the likelihood of growth over the long term, is very, very strong. There is always a level of speculation in that style of investing, in contrast to, say, for example, alternative investments that I really love, which are good for cash flow, but which have much less speculation. However, they are a necessary part of your investing journey as you need to grow your capital base and your net worth. But I think this whole idea of staying out of the market because you're predicting or you're trying to wait or hold out for a better price, it is, again, it's a personal decision. I'm not criticizing it from the viewpoint of saying it's right or wrong. What I'm more trying to point out is that we don't know which way the market's going to move, and we certainly don't know what the future holds. So the next thing I want to focus on is this idea of cash control is king. So when we're in an environment where inflation is rising and possibly at all-time highs, even those high net worth individuals I work with that have really good income, the advice is still the same. You need to monitor your spending and identify the bleeds. You need to be aware of your net cash position. One of the things that I often do as a starting point with most of my clients is I speak to them about, what does it cost for you to run the baseline level of your lifestyle? And it's really amazing to me that most people have no idea of what that number is. And why that is difficult, or why that is potentially a risk for you, is as inflation starts to creep, not only can you kind of put yourself in a difficult situation from a lifestyle stress cash point of view, but it can certainly impact your investing and investing decisions as well. Many of the investors that I've worked with over the last 12 or so years are reliant on having leftover income from their primary income to fuel their investing. And one of the things that can happen is that in an environment where, and I'm just pulling numbers out of the air now, let's say your baseline living costs is $100,000. And then suddenly it's $130,000, $140,000 to maintain the same level of lifestyle. Then if your goal was to set aside $50,000 a year, suddenly that could become $10,000 to $20,000 or potentially zero. And so you want to be mindful, not only that you may not have those reserves for investing, but even just from an emergency cash point of view, you could end up falling short. So cash control is king. And so it's really important, if you haven't already done the exercise, you really, really need to be analyzing what does it cost in today's money for us to run our household. And the exercise that I run people through often highlights a discrepancy. And I have talked about this in past podcasts. It highlights a discrepancy between the amount of money they think they're able to set aside every year to fuel their investing and their cost of living, and what they actually are setting aside. So I think you want to kind of put yourself in a position where, as much as possible, you have a high degree of control over the cash flow coming from your investments, the cash flow coming out of your business, your income, and the cost of what it costs to run your household. It's really amazing to me that a lot of people don't know those numbers. And from a viewpoint of stewardship, that's kind of one of the fundamentals of kind of strengthening that pillar in order to really move forward as a successful investor. The final piece that I want to cover on today is, and it's probably the thing that people are most interested in, is what should you be investing in? Now, as prices tend to kind of go up particularly in real estate, it's because there are more dollars chasing relatively fewer deals. So, the purchasing power of each unit of money starts to decline. And so if we are in a high inflationary situation right now, certainly we're starting to see the real estate market cool very, very quickly. What is it that investors should be trying to buy? And the answer is obviously very simple, but you need to be focusing on investments with returns that are equal to or greater than inflation. And unfortunately, I think there are a lot of investors right now who carry investments which maybe were fine to have left in their portfolio all these years while it was a booming market. And maybe those things were dogs or they were lemons and they were lagging, but it didn't matter. But now is a point in time more than ever to be, focused on this idea of what is it that you need to do with your portfolio in order to get to that next level? If you are in the fortunate position, I might add, to have cash reserves set aside for investing, I'd be really mindful of, what are the likely returns in today's money? Because the reality is, if you invest in something that gives you a lower return than the rate of inflation. And you know what I would do, guys? I would honestly assume the worst case scenario in your mind about what the inflation rate actually is. If you're happy to accept the government reporting that it's around that 7-8% mark, then that's fine. But me personally, I'm actually assuming a much higher rate of inflation. So when I'm looking at investments, when I'm trying to select investments right now, I at least want to be, and just for argument's sake, let's assume the 8% is about right. Let's aim for investments that are going to give us at least that rate of return. Otherwise, we are losing money, we are losing gains, and potentially putting a big dent in our hard-earned gains over the last few years. The other part that I would also say to you is that in the event that the market were to take a dip or tank in the next 6 to 12 months as a result of varying, economic factors. What I would say is that, again, it's not cause for panic. If you think about the ridiculousness of the growth we've had over the last 2 years, in some case, some markets have had 20% growth per annum 2 years consecutively. Some markets have had more than that. What I'd argue though is that, one way to look at it, and I know it doesn't bring comfort to those people who have recently entered the market, but really a drop of 20% in property values in the market really would be just a pullback to what might have otherwise been, pretty regular growth over those 2 years. So, I think, again, if you're new to the market, I can see why that would be incredibly painful, but you've got to remind yourself you're playing the long game here. So the focus needs to be on, can I afford to carry these investments through the turbulence which lies ahead? Do I have enough cash reserves? Am I in full control of the cash and capital within my world? Do I have a good sense of understanding about what my life costs? And do I have the capacity to keep adequate cash reserves and continue to fuel my investing? Or do I need to just allow my investments to marinate and grow while I get myself on an even keel? So guys, I know it's been a bit meandering today, but I think this topic of inflation is really important. I think there's too many investors out there that are outright panicking. And certainly, when you go to the petrol station and you're paying in excess of $2.20 per litre with no reprieve on the horizon, I understand that those things can be great causes for concern. But I would encourage you to temper your emotions and remain dispassionate about how to continue to protect and grow your portfolio so that when this market cycle changes gear, which it will, you'll be in a much better position to take advantage of future opportunities. We didn't really talk much about alternative investments today, but certainly I do want to kind of emphasize that one of the reasons I love this asset class is that it does deliver that, reliable income stream, which from my point of view is really important during volatile periods of the market. A lot of people are attracted to alternative real estate and alternative investments because of that desire to build passive income. But the piece that sometimes gets forgotten and then you're reminded of in times like today is that the cash flow is not just a mechanism for achieving financial freedom sooner, but it's also significant protection in, uncertain times. So guys, I hope this has been useful. I really look forward to catching up with you on the next few episodes. Until next time, take care. You've been listening to the Alternative Investing Podcast. If you're feeling frustrated that despite doing everything right in the property investing playbook and you're no closer to financial freedom, then head on over to inkosiwealth.com to learn more about how you can use alternative investments to catapult your investing income and blend strategies to shave decades off your timeline to financial freedom. See you on the next episode.